Welcome to the deep dive. For generations, it felt like there was this set path, right? You finish high school, you get that college
The
diploma.
golden ticket?
Exactly.
Yeah.
And the good jobs would just sort of follow. That degree, it wasn't just paper. It felt like the ultimate guarantee for, financial security.
Hmm.
But now here we are in 2025, and that certainty, it feels like it's really shaking. You've got this mountain of student debt, this crazy volatile job market for new grads,
Yeah.
and people are starting to seriously question the whole value proposition of college.
Oh, absolutely. And look, that skepticism isn't just chatter. It's measurable. We can see it in the data, and it's reached a really critical point.
Right.
But the great thing about doing a deep dive like this is we can step back a bit.
Yeah.
We need to look beyond just the monthly loan payment that makes everyone panic
Yeah.
and really try to put on an investor's hat here. Think like an investor. When you actually weigh the huge, sometimes terrifying upfront cost against the massive lifetime financial benefits that still exist, the picture gets a lot more complex, more resilient maybe, and definitely more paradoxical than the headlines make it seem.
That's exactly what we're trying to do today. We want to cut through all that noise. Forget the surface level stuff, the stories about overeducated baristas or, endless debates on loan forgiveness.
Right.
We're going to actually try and quantify the real value of getting a degree right now in 2025. We'll break down the total cost, including those huge hidden ones people forget about.
The opportunity cost.
Exactly. Compare the return you get to other big investments, like, say, the stock market. We'll look hard at how your choice of major is now, like almost everything.
That really is key.
And check out some of the alternatives popping up and the policy fixes people are trying. Okay. Let's really unpack this massive investment decision. So before we dive deep into the dollars and cents, we kind of have to acknowledge the mood, right? The feeling around higher education right now. Our sources are showing this, well, frankly, shocking dip in public trust.
It's definitely an institutional crisis of faith. The data, it's really stark. So overall, only about 36% of adults say they have a great deal or quite a lot of confidence in higher ed today.
36%. Wow.
Yeah. And think about this. Back in 2015, just 10 years ago, that number was 57%.
57 down to 36. That's not a slow drift.
No, it's a collapse. It's a massive systemic loss of trust in the whole institution's promise.
A 21-point drop in a decade. That's huge. I kind of assumed this was maybe more concentrated, politically or economically, but you're saying this skepticism is pretty widespread, even if some groups feel it more strongly.
That's right. I mean, the decline, it really cuts across almost all demographics, age, region, you name it. But the drop is steepest among Republicans. Their confidence has fallen, get this, 36 percentage points over the last decade.
Wow.
But look at the overall picture again. People aren't just shifting from high confidence to medium confidence. No, they're going straight to very little or none. About 32% of people now say they have very little or no confidence at all.
So almost as many people have zero confidence as have high confidence.
Exactly. And that kind of psychological shift, that changes the whole dynamic.
Okay, so why? If the underlying economics, which we'll get to, might still be okay on average, what are the big reasons people are giving for ditching their faith in the system?
Well, it's really two main things, and they're both tied directly to that value idea. The biggest one, the one almost a third of people mentioned, is just the sheer cost, the expense. That financial hurdle is huge.
Price tag.
Yeah. But right behind that, about 24%, so almost a quarter, is this deep concern about preparation. People feel students just aren't being taught the skills they actually need to, make it in today's workforce.
So it's not just the debt, it's am I even getting something useful for all this money?
Precisely. It's a perceived mismatch between what's taught and what's needed out there.
And this anxiety about cost, it's clearly splitting students based on their family income even before they apply, isn't it?
Oh, absolutely. You see this really clear split among high school students thinking about college.
Yeah.
If you look at higher income students, about 88% still believe a four-year degree is worth the cost.
Okay.
But now, look at the students who are most worried about the price, lower and middle income kids. Among that group, only 57% think the degree is worth it.
Oh, only 57%.
Yeah. So for almost a third of those students who are already financially stretched, that sticker shock is so high, the four-year degree starts looking less like an opportunity and more like a gamble they just can't afford to take.
This pressure from the outside, this crisis of confidence you mentioned, it's actually changing how colleges have to operate, isn't it? They're being forced to talk like businesses now.
That's a really crucial point.
Hmm.
Colleges are now under just immense pressure to prove their ROI, their return on investment.
Like a stock.
Exactly. It's language straight from finance. They have to show a quantifiable payoff in dollars.
Mm.
We're seeing states like Colorado and Texas actually building graduate earnings into how they decide funding from taxpayers, how they report to the public. The old idea of just value in the abstract. That's kind of fading. Now, the main goal for these institutions is lowering the net price, what students actually pay, and clearly boosting what their graduates earn. They're basically managing a balance sheet now, not just, an academic program.
Okay, let's pull out the calculator then. Let's try and quantify the first part of that ROI. The cost. It gets confusing, right? There's the sticker price, the net price, total cost of attendance. Let's start with the big number people see. What's the average cost for everything?
All right, so if you look at the total cost of attendance, or COA, for four-year school in the U.S., and this includes tuition, fees, books, supplies, and living expenses.
Everything.
Everything. It averages out to about $38,270 per student per year.
Wow. Okay, that number alone explains the panic.
It does. And over the 21st century, the overall cost of college has more than doubled. It's outpaced inflation by a lot. Tuition alone has been growing at something like 4.04% compound rate each year.
When people hear that $38,000 number, they probably think tuition is the biggest part. But is that actually true for, say, a typical student at an in-state public university?
Surprisingly, no. For that typical student going to a public school in their state,
Right.
living on campus, the total COA is actually closer to $27,146 a year.
Okay, lower, but still a lot.
Still a lot. But tuition itself is only about $9,750 of that, so maybe 36% of the total. The single biggest cost after tuition is room and board. That averages about $12,302.
So where you live and eat costs more than the classes themselves.
Often, yes.
Yeah.
That's a really important point. The cost of living while you're in college can actually be higher than the cost of the learning part.
Which brings us to that really key point you made earlier, the one that gets lost in all the doom and gloom, the net price. If the sticker price is so high, how come some students are apparently paying less now than 10 years ago?
Yeah, this is the paradox, and it's why things get so confused. We have to separate the list price from what people actually pay. So while that sticker price has shot up, recent research shows that the inflation-adjusted net price, where the average student really pays out of pocket after all the grants, scholarships, financial aid is counted,
Okay.
that net price has actually fallen by 40% over the last decade at public in-state universities.
40% less in real terms? How is that possible? That seems huge.
It is huge. It's mostly because of more institutional aid from the colleges themselves and bigger federal grant programs like Pell Grants. For the average student at a public university, the net price dropped from about $4,140 a year to $2,480 a year.
Okay, wait. If the real cost is down that much, why is cost still the #1 thing freaking people out?
Because the system is incredibly misleading. Students see that massive sticker price first, way before they even apply or get an aid package.
Right.
So the fear of maybe owing, say, $150,000 stops them from even applying in the first place, or it pushes them towards maybe cheaper but less suitable options. Even though, in the end, aid might cover a huge chunk of it, the perceived risk feels way higher than the average actual outcome.
And this lower net price, it's actually affecting how much people borrow too, right? Loan balances are changing.
Exactly. Because there's more grant aid available, the average amount students actually have to borrow has dropped by about 17%. It's down to around $27,100 now for those who do take out loans.
Oh.
So there's evidence that for a lot of students, these support systems are working to reduce the debt burden. It's just that public perception hasn't quite caught up.
But okay, those direct costs, even the net price, that's only part of the equation. If we're treating college like an investment, we have to talk about the biggest hidden cost, the one that can actually dwarf tuition. Opportunity cost.
Ah, yes. Opportunity cost. It's the earnings you give up because you chose to be in class for 4 years instead of working.
Right.
This is the silent killer, financially speaking, in the whole college calculation.
Yeah.
Think about it. The median wage a high school graduate earns in those first 4 years out of school, it's estimated around $150,000 in 2024 dollars.
Wow. So you're immediately down $150,000 just by choosing to go to college.
Pretty much, yeah. That's money you're sacrificing right away to get the degree.
So let's try and calculate the ultimate price tag then. We combine the direct costs, maybe that lower net price, but add back the lost income, the interest on loans.
Oh, and the fact that most students don't finish in 4 years, right? Only 42%. Most take closer to 6.
Yeah, that's a critical factor. So when you roll all of that together, the lost income, the actual payments, the interest paid over maybe 20 years, plus the cost of those extra 1 or 2 years it takes most people to finish.
Okay, what's the number?
The ultimate price of a typical bachelor's degree can easily hit. Well, it's estimated as high as $562,868.
Over $500,000.
Yeah, it's a mind-bending number. And it explains why the debt feels so crushing, even if the average initial federal loan is only $38,375.
Because it's not just the initial loan, it's the total sacrifice over time.
Exactly, and the repayment period reinforces that. The average borrower spends closer to 20 years paying it off, paying an average of $2,636 just in interest each year. It's a massive long-term investment that really demands scrutiny. Okay, that $500,000 figure is, yeah, that's terrifying. It perfectly captures the anxiety we talked about. So now, let's flip the coin. Let's look at the payoff. Despite all that turbulence, the scary cost calculation, why do financial experts still argue that, on average, getting a college degree remains a really good investment?
Because we measure the payoff not by feelings, but by, well, financial performance.
Right.
When economists look at the value of a degree, we use something called the internal rate of return, or IRR.
IRR.
It's the exact same tool investors use to judge if buying, say, a rental property or investing in a tech stock is worth it. And for the median college graduate in 2024, the estimated return on their college investment was remarkably strong, about 12.5%.
12.5%. Okay, break that down. Why is that number so impressive compared to, say, just putting money in the stock market?
Well, think about your typical long-term investments. The stock market, right?
Yeah.
If you invest in a broad index fund, historically, the long-term average return is around 8% a year. Bonds, which are much safer, usually give you maybe 4%. So a 12.5% IRR means that, on average, every dollar you invest in your education is growing faster than almost any other reliable large-scale investment you could make.
Better than the stock market, basically.
On average, yes. And what's really interesting is that this 12.5% rate, it's held pretty steady, somewhere between 12% and 13% for the last 30 years.
Wow, even through recessions and booms.
Yeah, it shows a certain resilience through different economic cycles. It confirms that, again, on average, a college degree is still one of the most profitable and maybe even inflation-hedging investments a person can make.
That's a really powerful way to frame it. It makes it sound like the public view of higher ed as this inefficient, bloated system.
Yeah.
Kind of hides the fact that it's actually a massive economic engine.
Oh, it absolutely is. People just don't grasp the scale of its financial clout.
Oh.
Our sources had this great comparison, actually. Think about Oxford University in the UK. Its annual revenue is over £2.9 billion. Now, compare that to a really popular UK bakery chain, Greggs. Oxford's revenue is more than £1 billion higher than Greggs's.
£1 billion higher than a huge national chain.
Yeah. Universities are these enormous economic generators, often much bigger than the consumer brands people see every day.
Yeah.
That power is just often really underestimated.
And the heart of this great rate of return, it comes down to the wage premium, right? The extra money you earn with a degree. Let's put some numbers on that gap.
Yeah, the wage premium is the bedrock. The median college grad with a bachelor's degree was earning about $80,000 in recent years.
Okay.
Compare that to the median worker with only a high school diploma. They were earning around $47,000.
80 versus 47, that's...
It's a difference of over $32,000 a year. That's roughly a 68% income boost just from having the degree.
And if you project that $32,000 difference over, say, a 40-year career, even after taxes and stuff, that lifetime benefit must easily swamp that scary $500,000 ultimate cost figure.
Oh, easily. Over a lifetime, that premium adds up to a net benefit well beyond the costs. Conservatively, we're talking somewhere between maybe $350,000 and $600,000 in extra lifetime earnings compared to just a high school grad.
Wow.
And it's not just the money, it's also stability. A college degree offers significant protection against recessions. Historically, grads are way less likely to lose their jobs when the economy tanks, and they're the most likely to be employed even when a crisis hits. In bad times, the difference can be huge. People without degrees can end up earning 75% less than those with a bachelor's. It's an asset that tends to hold up when others don't.
Okay, so we have this big, persistent financial advantage, that 12.5% average return. But If the average is so good, why is there still so much anxiety? Why do we hear so many stories of people struggling where it didn't pay off? It feels like the value isn't spread evenly.
That is a core paradox right now. The average is great, but the variation around that average is extreme, huge. The idea that just having any degree guarantees success, that's definitely over. The value now really depends almost entirely on what you study. And yeah, to some extent, where you study it too. We're seeing what the sources call the college major revolution.
College major revolution, okay.
Yeah, students are acting like really smart, debt-aware consumers. They're actively choosing majors, specifically because they lead to higher-paying jobs.
How much is this student behavior actually changing what gets taught, what degrees are popular?
It's a seismic shift. Look at degrees in high-wage fields, let's say, majors, where the median starting salary is over $60,000. The number of degrees awarded in those fields grew by 60% between 2010 and 2023.
60% growth in just over a decade.
Yeah. And here's the kicker, that growth in high-wage fields, it accounts for almost all the increase of the total number of bachelor's degrees awarded during that time.
So basically, the only reason more people are getting degrees is because they're chasing the money majors.
Pretty much. The whole system is being pulled towards fields with high earning potential.
Okay, so who are the winners and losers in this revolution? Which fields are booming?
Well, the demand is really focused on applied tech and healthcare, computer science degrees. Their popularity has basically tripled since 2010.
Tripled one.
Nursing degrees are up 96%, engineering degrees up 63%. Meanwhile, a lot of the traditional humanities fields are seeing big drops. English and linguistics degrees down 39% since 2010, history down 38%, sociology down 17%.
That shift, it has really big implications, doesn't it? We're seeing a generation making a very conscious trade-off. Maybe sacrificing intellectual exploration in the liberal arts for a more guaranteed paycheck.
Look, it's a survival strategy when you're facing potentially huge debt. And, it's kind of necessary because, unfortunately, not every degree even breaks even. One estimate suggests about 23% of all bachelor's degrees might actually have a negative return on investment.
Nearly a quarter.
Yeah, once you factor in the full cost, the lost wages, and critically, the risk that you don't even finish the degree. If you invest the equivalent of $500,000 into a major, where you start at $35,000 a year, it can take decades just to get back to zero.
Let's drill down on those specific salaries. Where are the absolute top earners coming from, and how different is it at the bottom?
Well, the highest returns often come from really specific niche kind of vocational programs.
Yeah.
For instance, 6 years after they start, graduates in fields like naval architecture, especially if they go into oil and gas.
Okay.
They can pull starting salaries between $75,000 and $100,000. And interestingly, maritime academies, schools that focus on very specific technical training for the shipping industry, they actually make up half of the top 10 schools for graduate earnings.
Specialized skills pay off. And on the other end, where's the biggest financial risk in terms of major?
Well, the analysis showed the 100 college programs with the lowest starting salaries often included things like drama, fine arts, dietetics, and anthropology. For example, the top median starting salary for drama grads was around $36,600. For fine arts grads, it was $44,500.
So starting salaries in the 30s and 40s, when the investment cost is potentially hundreds of thousands, that makes the math really tough.
Exactly. It makes the financial justification incredibly fragile, especially if you took on debt.
What really strikes me here is that the brand name of the university doesn't seem to guarantee anything anymore. You're saying the specific program matters more than the fancy university name.
That is absolutely key. Even at really elite, famous universities, the ROI can vary wildly depending on the subject. Take UNC Chapel Hill, a great public university. Undergrad degrees there in applied math or business, they show really high returns, easily pay for themselves. But graduate degrees, even from UNC, in fields like psychology or foreign languages, they often show much lower, sometimes even negative returns.
So you really have to research the job outcomes for the specific department or program, not just assume the university's overall reputation covers everything.
100%. Don't just rely on the name on the sweatshirt.
And we should also point out, access to these high-paying majors isn't exactly equal for everyone, right? That kind of locks in existing economic gaps.
Yet the demographic differences are pretty stark and frankly concerning. You see, male workers, white workers, and Asian American workers are heavily overrepresented in those really lucrative STEM fields we talked about. Computer science, engineering, high-level math.
Right.
Meanwhile, women are overrepresented in fields like education, healthcare support, social sciences. Now, these are absolutely vital fields.
Critical jobs.
Critical jobs. but historically, they just tend to have a lower lifetime wage premium attached.
Yeah.
This creates a real risk of leaving talent on the table, especially when the country is actually facing a skills shortage.
Yeah.
And it kind of reinforces the idea that this major revolution isn't benefiting everyone equally.
And if we link this back to how happy graduates are with their choice, it sounds like people feel best when the money they spent clearly translates into a job skill.
Yeah, that seems to be the pattern. The data shows grads are most satisfied with courses that have a really obvious vocational link. Think medicine, health sciences, architecture, computer science.
You can see the connection to a career.
Right, the immediate usefulness provides that tangible proof of value. On the other side, graduates from fields like journalism, marketing, even social work, they were among the most likely to say they regretted their choice of major. It suggests maybe a disconnect between what they expected and what the career path actually looked like.
Okay, so we've established the long-term ROI picture is strong if you're strategic. But for graduates right now, today, the short-term picture sounds really tough. You mentioned young people are facing one of the hardest entry-level job markets in, what, a decade?
Yeah, it's a real economic headwind they're sailing into.
Yeah.
Just look at the unemployment numbers for that key group. Degree holders aged 22 to 27. In March 2025, that rate hit 5.8%.
5.8%.
Now, if you ignore the crazy spike during the pandemic, that's the highest it's been since 2012. And here's the really weird part.
Okay.
That 5.8% unemployment rate for young grads, it's now higher than the overall U.S. unemployment rate, which is sitting around 4.2%.
Wait, grads are having a harder time finding jobs than the general population? That seems completely backward. How does that happen?
Well, it's kind of a perfect storm hitting them. Short term, you've got lingering economic jitters, trade war stuff, inflation worries, and this thing analysts call the no hire, no fire economy. Meaning companies are reluctant to lay people off, but they're even more reluctant to bring on new, expensive entry-level hires.
Okay.
And second, where the job growth is happening right now, it's concentrated in areas like healthcare, government, hospitality. Those aren't always the high-prestige, high-salary jobs that new grads are aiming for.
Mm-hmm.
The traditional grad jobs in IT, legal, accounting, they've been kind of sluggish.
And then there's the big long-term structural shift. AI, artificial intelligence, starting to automate those classic entry-level white-collar tasks. That first step on the career ladder, it feels like it's shrinking.
It is shrinking, and fast. AI and automation are getting really good at handling entry-level knowledge work. Think basic research, drafting simple documents, data entry, some analysis.
Stuff interns used to do.
Exactly. Those were the jobs where new grads learn the ropes. If those jobs disappear, the whole pipeline gets clogged. We saw that stat. 52% of the class of 2023 ended up in jobs that didn't even require a degree a year after they graduated.
Half of them.
Half. And look at big tech firms. The number of new roles they had for people with less than 1 year of experience, it dropped by 50% between 2019 and 2024.
That's exactly the kind of story we hear. I'm thinking of that example in the sources. Pawasha Zahid, right? Finished her master's in data analysis near Silicon Valley, super qualified.
Yep.
But still struggling to find that first data job. She's living this exact problem.
Her story is becoming incredibly common. Students go get degrees in these high-demand fields like data science or CS, and then they graduate and find the entry point jobs are just gone, or partly gone.
Right.
It forces them to try and compete for jobs that need mid-level skills, but they haven't had the chance to build that foundation. It's this kind of whiplash that's really accelerating the shift away from just relying on the diploma and towards proving you actually have the skills.
Which leads us right to that big change happening with employers. Major companies dropping degree requirements because the piece of paper doesn't guarantee what they need anymore.
Precisely. Companies like Google, Apple, IBM, Accenture, they're really pushing this. They're moving away from demanding a bachelor's degree up front and focusing instead on proof of skills. Can you show us what you can do? Do you have real projects? IBM even coined that term new-collar jobs for roles where specific tech skills matter way more than a 4-year degree. Because AI is automating the easy-to-measure technical stuff, employers are putting a huge premium on the uniquely human skills.
Okay, so if it's not just the degree anymore, what skills are employers really looking for from graduates now? What does the college system maybe need to focus on delivering better?
Yeah, it's more than just soft skills. It's about higher-level thinking. Employers are screaming for adaptability, complex problem-solving, ethical judgment, critical thinking, good communication, and crucially, teamwork, being able to work effectively with others in messy, fast-changing situations.
But wait, aren't those the exact things a good liberal arts education is supposed to teach?
Ironically, yes. Those are the core competencies college is designed to build. But employers consistently say graduates are lacking in these areas.
Mm.
So the challenge for universities isn't just teaching the technical stuff anymore. It's figuring out how to truly cultivate that intellectual flexibility, that ability to adapt, to engage in reasoned debate skills that are really hard to automate and absolutely essential for the future. That's where the real quality of the college experience lies now.
Okay, since cost is still the #1 reason people are losing faith. You said a 51% think more affordability would restore their trust.
Yeah, number one issue.
We have to look at solutions aimed directly at the price tag. And the big one there is the free college movement, often based on that Kalamazoo Promise model, right?
Right. The Kalamazoo Promise in Michigan
Mm-hmm.
started way back in 2005. It's kind of the classic example. It's a huge deal. Offered free college tuition to kids who went through the Kalamazoo public schools from K-12 with partial scholarships if you were there for less time. The whole idea was to tackle that financial barrier directly.
But how these programs are set up seems to really matter. We hear about first dollar versus last dollar. What's the difference, and why does the Kalamazoo way seem to work better for lower income students?
Yeah, the structure is critical. Kalamazoo uses a first dollar model. That means the Promise Scholarship money is given to the student no matter what other aid they get, like federal Pell Grants.
Okay, so it stacks on top. And Pell Grants are for low-income students, right?
Exactly. Pell Grants are federal money specifically for students from lower-income families. Now, compare that to the last dollar approach, which is what many state programs try.
Like the one in Maine that got cut.
Yeah, like that one. A last dollar program only covers the tuition cost that's left over after all other aid, including the Pell Grant, has been applied first.
So under last dollar, the Pell Grant just ends up covering tuition that the state program would have covered anyway. The student doesn't really see the benefit.
That's the problem. It basically wipes out the advantage of the Pell Grant for that student. They can't use that federal money for the things that often actually stop them from finishing college. Room and board, transportation, food, maybe childcare.
The living expenses again.
Exactly. Since those living costs are often the biggest hurdle, the first dollar model, like Kalamazoo's, is way more effective because it frees up that crucial Pell money for students to actually live on while they study.
And the Kalamazoo program also seems built for how complicated student lives can be today with that flexibility.
It does. The scholarship is good for up to 10 years after high school. That's huge. It gives students flexibility if they need to work first or just mature a bit or wait until their family finances are better before starting college. It recognizes, that not everyone is ready or able to go straight from high school.
But even with that smart design, even the Kalamazoo Promise has seen some challenges, right? Enrollment hasn't stayed as high, especially among the students it was meant to help most.
That's the tough reality. I mean, it's still successful in many ways. More students use it now than in the first year. But overall, college enrollment among the eligible kids has dropped from about 86% down to 63%.
Wow, that's a big drop.
And the decline was mostly among lower-income students, the very ones who likely needed to get a job right away to help support their families. It shows that even free tuition can't always overcome the urgent need to earn money just to cover basic living costs, especially when inflation is high.
And politically, these free college programs seem pretty fragile, don't they? Especially when state budgets get tight.
Oh, they are extremely vulnerable. State-level programs often struggle to find stable funding, and they're usually first on the chopping block when there's a budget shortfall. Maine cutting its program after just 3 years because of money problems is a perfect example.
Yeah.
As one expert, Peter Granville, pointed out, even if people generally like the idea, these programs are often seen as the easiest thing to cut politically when tough budget decisions have to be made.
Yeah.
They're often built for maybe short-term political points rather than long-term stability.
Okay, so we've done the deep dive on the real ROI of college in 2025. And if you try to boil it all down, the core tension is just crystal clear, isn't it? On one hand, the basic economics, the financial fundamentals of getting a degree, they still look incredibly strong. That 12.5% average return is hard to argue with financially.
It really is, yeah.
But on the other hand, the way the system works, the execution, the lack of transparency, who actually gets access to that value, it feels like it's failing a lot of people. And that's leading to this huge anxiety, crushing debt for individuals, and this crisis of public trust we started with.
Absolutely. And the key takeaway, I think, for everyone listening, whether you're a student, a parent, just thinking about this, is that you just cannot treat college as the default next step anymore. It's not automatic.
Right.
You absolutely have to approach it like a major strategic investment, We're talking potentially $500,000, all in. It demands serious research, real due diligence.
Mm-hmm.
You cannot assume every major or every university will give you the same financial outcome. It just won't happen. Your success now really hinges on digging into the specifics. What's the likely ROI for this specific program? What are the actual job placement rates and salaries for graduates of this department? Don't just look at the university's overall reputation.
That intentional research is the key.
In 2025, yeah. That level of research is the difference between getting a really valuable asset for your future and taking on a liability that could haunt you for decades.
Okay, that brings us to our final provocative thought for everyone listening. We spent a lot of time talking about the current job market, which is undeniably tough for new grads, the economic wobbles, the AI fear, that high unemployment rate for young degree holders.
Yeah, the present looks messy.
But we also need to look further out. The U.S. is actually heading towards a massive long-term skills gap. Georgetown University projects that because of all the baby boomers retiring, plus falling college enrollment rates,
Right.
the country could be short 5.25 million workers with some kind of post-secondary credential by 2032, and that includes a shortage of 4.5 million people, specifically with a bachelor's degree or higher.
A huge gap is opening up.
So here's a question. If the economic reward for getting the right degree is still soaring, that 12.5% average ROI is real A&D, the supply of people with those degrees is set to shrink dramatically over the next decade. What does that massive future shortage mean for the value and the necessity of getting a specialized high-demand degree 10 years from now? Could that competitive advantage, that 12.5% return, actually spike even higher as qualified graduates become rarer and more indispensable? That future scarcity? That might be the ultimate wild card to keep an eye on as you make your own educational bets.